Greetings all. Today I just want to have a look at the finance section in a bit more detail, and two components that are influenced through there, and that's leverage and days of working capital. As you work through your rounds and you start to get into the 4, 5, 6 and 7s and so on, you find there's a bit of tension between these two concepts. You'll get leverage high and and days of working capital will decline. Many people come to me and ask me, what do I do about this dilemma? I'm going to give you a bit of an insight into it today in a kind of a non-technical way. Just have a bit of a look about where you can sort of find some information on it and some ways in which you can manipulate it. So let's assume now the company's been operating for a number of years and all the decisions have been made. And this is what we're looking at here. We've just arrived at the finance section, and we need to start figuring out how we're going to deal with things. Now, I'm going to show you some other areas that you may not have been aware of to date, and you can utilise them. The reason I haven't showed them to you earlier is because there's a lot to learn, and I think we get to understand the basics, and then you can build on a little bit more to some of these other areas. The other thing is, of course, that the area that I'm going to show you today, which are pro formas, are kind of like a bit tricky, and they take a bit of experience to be able to kind of understand how you can use them. When the first assignment finishes, typically we have 2 weeks then of training, going back to 8 rounds, so you can go backwards and forwards as many times as you want until you try to 8. And then it's that time you can actually start using the pro forma and see how pro formas work. But I want to show you, I'll jump in a bit earlier today and show you. Some people might be ready for it, but the majority aren't. Just show you how we can use that and use it to give you a bit of example about how we can influence leverage and days of working capital. So here's our options as well. As we can see here, we have, we need to pay this debt off. It's not looking, we've got 5 million, 5.9 million, almost 6 million down there. That we need to cover. That needs to be 10 million in the black. We've invested 12.8 million there, and we have a number of things that we could do. My initial in the walkthrough, I suggested to you always pay off by a long-term debt and a long-term debt over here, I should say, and issuing stock, and that keeps you out of trouble for the first few years, maybe even 4. But later on, you're going to need to make some other decisions, and this is what today's tutorial is about. Some people are finding this already, and when they get to round 4, others aren't. Sometimes you can get into the position I'm describing today by making a few other mistakes. So it's not necessarily just the way you pay off your final financial assets. It's other things as well. So first, let's go to the pro forma section. You can see a whole range of different things here. There's balance sheets, income statements, and so on, balance scorecard, and also ratios. These are work in progress documents. When you get your courier at the end of the year, your balance sheet, your ratios, your balance, and all those sort of things are actually fixed in what you actually got. These are work in progress sort of things, and it assumes that you're going to do the numbers that you're seeing here assumes that you're going to do everything that you said you're going to do. You're going to sell everything you sold, and competitors didn't make it too hard on you, and all those kinds of things. So that's what work in progress, and that's why I kind of leave it till later before I start introducing people to these. But if the first thing we'll have a look at today is ratios in here, because this gives you a bit of an idea about what those ratios are. You'll see that these are also pop up on your balance scorecard. So today we're going to be looking at leverage. If you want information on it, well, there's a ton of information on it. It summarises down the bottom what it means. But basically, I think that the first thing to do is to think about, well, what is it? First, it's assets divided by equity. So it's your total assets divided by equity, and that's called leverage. And we have a leverage at the moment of 1.6. So we'll go into this in a bit more detail later on, but the first place that I look at is, well, if leverage, what is it? Okay, it's the total assets of a company divided by equity, and it gives us 1.6. While we're here, we'll have a quick look at working capital. I'm going to come back to this a bit later on. Working capital is down here, and again, you've got tons of information about this. Working capital refers to sort of days of working capital, refers to how many days could we operate if sales just dried up now. If we had no more sales, how many days could we keep working for? This one says 65. And there's some metrics around this as well. So there's ratios. I come here to get some pretty in-depth information about what they all are. And I also come here to just figure out, how do I calculate these sort of things? Because if I know what's involved in the formula, then I know what I can do to be able to manipulate these numbers over on this side. So let's go back now and have a look at the balanced scorecard pro forma. Some of you have found this. Again, it's a work in progress, and this is why I do encourage students not to go here initially. You'll see down here, a score for round 2, which is 52.6 according to this. Typically what happens lots of times, people come in and they say, oh, but I got 52.6. It told me I got 52.6, but then when I processed the round and I looked at my balanced scorecard, it said I got 48. The reason is because this is a work in progress. And, it takes a while to be able to understand how you can actually use it. So I'm not going to go too much into that today. You can play around with that later on yourself, but I am going to be using it to illustrate how you can actually use it to figure out and manage leverage and days of working capital. So let's have a look at what we've got here. Firstly, we can see here's leverage. We've got 5.3 out of 8. It's maybe not too bad. This tells us what it is over here. Also, this gives us an indication about what we need to be. If you remember, we were 1.6. So where we fall between this one here, so we get partial credit. We're 5.3 because if you remember, our number was 1.6. So we're a little bit we're into that one there. So we're getting a partial credit for it. Thus that one. What I need to do if I want to get full credit to that, I need to be between 1.8 and 2.8. And I'm going to come back and have a look at that now. Before I do, let's have a quick look at the working capital. Well, I'm fine on working capital. 5, and 5. That's magnificent. My score, my days of working capital was 65, so I fall nicely in between there. I'm doing all right. So that's kind of where I need to be, and I've got full credit for that. So let's go now up into finance and see what we need to do. Well, the first thing I need to do is I need to get that to about 10 million in the black. So if we follow what I told you to do, I need to finance the company. So to get that 10 million in the back, I need to borrow 16 million. So if I said I'm going to issue stock here for 8 million, buy stock, and I'm also going to issue long-term debt. That was the instruction I gave you, which will work well for the first few rounds, but eventually as you move forward, and you start getting a lot more money and you make a few errors and a few things start happening, competitors start playing games with you, you can get yourself into a bit of trouble. So let's have a look now. This is looking pretty good, isn't it? I've got here 8.9 there. I've paid that off. Well, let's go and have a look at what the pro formas say about this. So I'm going to come down to the balanced scorecard again, and I can see my leverage dropped. I did everything according to what I suggested, and I've got no days of working capital left. So a disaster happened. When I went back to cover my debts, I completely disrupted days of working capital and reduced my leverage score. So the question is what's going on here? The first thing is I have to pay that money off. There's no way around that. I need to get that in the black. If I don't, forget leverage, forget work capital, forget everything. I'll be in deep trouble. So I have to do that. The other things we need to be able to look at here, and I think one and the simplest way to be able to look at this is to look at the pie chart. This pie chart tells me how I've been financing my company. Now, I've been financing my company here mostly through retained earnings and common stock. It's not just in this round, it's the rounds before. Long-term debt is 32%, and common stock and these ones are like 60-something%, the two of them. Where you need to be in this is you need to have this area here, your debt area. At the moment, I don't have any current debt, but I need to have my debt area around about the same size as the retained earnings and the common stock. You see how it's kind of out of balance here. My retained earnings and common stock are over there. Now, if you can get these relatively even, half-half, that means your ratio is going to look pretty good, which means you will improve your leverage score. So, what I could do is to fix that. I won't buy common stock because I've already got a lot of that. So if I reduce that common stock out of there, you'll see that number 32.9 decreases. It's gone down to 28 because I no longer am using raising finance by issuing stock, selling shares. So I've decreased it a bit. And if you looked at the leverage score, it would be a little bit better. I would need to do something down here though, because I've only got 1.2 million, and that would be a bit risky running like that. So so what I'm suggesting, what I need to do now, again, to get this around about the same size as these two here, I need to start thinking about borrowing more debt. So I'm not going to use shares now. I'm going to use debt. So I'm going to have 16 million over here. Borrow all through debt. I can borrow up to 32 million in debt. Now that should be able to get me, what's going to get me way above that. So I don't need to be there. Basically I just need to borrow about, what do I need to get that to there? Say about 10 million. That might even be a bit too much. So let's recalculate that and see what happens. So no, I need to go up. So let's go back up to 16. So I've got up to there. 16 million there, none of this. Can you see what I've done here as well? I've increased the green, if you like, the common debt, or the long-term debt. I've increased it. And it's getting a little bit closer to being around about the same size as these two things together. So I've got another couple of million that I could get to 10 there, so I went back and put that up to 10. You don't need to be fussy like this, but I'm going to do it because I know what the numbers look like. So that gives me around 10.4 down there. And let's go and have a look what happens to leverage. We go to Proformas, we go to Balance Scorecard, and I'm 8 out of 8 with leverage. Perfect. So what I did was I just balanced those, balanced the kind of the ratio between how I'm paying off, how I'm financing my company. So I've got an even balance between long-term debt and equity. Shareholders don't like seeing you, borrow to pay off your debt using equity, using your shares and your cash. They like to see a nice balance between the two of them, and I've got that. But I do still have a problem down here with days of working capital. So I've kind of fixed one thing, and then I get into trouble with another thing. So let's have a bit of a look at days of working capital now, and see what we might be able to do to get both of these numbers looking better. Let's go back up to the here to the Proformas again, and have a look what the formula is for days of working capital. This is how you can figure things out. If you're an accountant or a financial manager, you'll know what this means. You know exactly what you need to do, but we're not. So, it's a good idea just to come here and understand, well, what makes it up? What's it made up of? Because I know what I need to do. I need to get these numbers. Let's go and have a look what numbers I need to get for this one here. I'll go to the Balance Scorecard. To get top points of days of working capital, I need to be around 30 and 90. I need to be in between 30 and 90. So that's going to be important. So let's go back up there and have a look at ratios again, and we can see that it's got something to do with working capital, obviously. When working capital is current assets minus current liabilities, and there's a whole range of information about that in there. And at the moment, I've got 33 million. And the days of working capital is the working capital divided by sales and the number of days in the year. So it's what's the sales per day divided into working capital, which is 126. So this basically says that if I didn't sell anything tomorrow, then I would have 126 days I'd be able to trade without, and still survive. Now you might think, well, the bigger the better. Well, no. Because, if there was a catastrophe tomorrow, well, it would be good, but typically there aren't every week or every year. And that would mean that there's just a lot of excess, cash lying around there that should be doing something else, and better utilized than, the way that it is at the moment. So let's see what we've got here. We've got current assets minus current liability. So we need to start working and thinking firstly on current assets and current liability working capital, and then we'll figure out what the numbers are. So come back up here now, and then we go to the balance sheet, because that's where we find these sorts of information. So here we've got our current assets over here. So what can I manipulate? What I've got to do is I've got to get that 33 million down. I have to make it smaller. If I make it smaller, it'll reduce the number of days of working capital, which might get me into that zone where I can get the full points. So I need to be able to reduce it. So let's have a look where we can find this sort of information. Here's my current assets. There's the 10 million I've got left over at the end of the year. Well, I don't want to change that. I could change that if I wanted to, but I don't particularly want to do that. That's accounts receivable. I'm waiting on getting that back from my from people I've sold products to. So there's not much I can do about that one. And that's inventory left over. Well, you know, I mean, that is a current asset because I can sell it eventually, but it's a lot of money sitting there lying around doing nothing. So my total current assets are worth 39.37 million. Now let's have a look at the liabilities. Now if we come across here, we'll see we've got accounts payable as a liability. This basically means what I owe people. I owe my suppliers. So I owe them $6 million there, and that's all I've got in current. You'll see long-term debt down here, 47. That's not considered current liabilities. And recall that the working capital is your current assets minus current liabilities. So there's not much, there's my current debt. Now you'll see that's more than the debt I've got. I've got 16 million of debt this year, but this number includes the debt, the long-term debt that's rolling over from my other years when I borrowed. Somehow or other, I need to be able to get that figure, this figure here, which is the total current assets, down lower than 33 million. So if I subtract 6 from this, that's where I get the 33 from. So what have I got to do with? What can I manipulate? I can't manipulate anything over here, but I can manipulate something on this side. So let me just go and show you what you can do there. Leverage is good. Everything's looking really nice. Problems with days of working capital. My issue is that I've got long-term. I need to be able to increase my current liabilities to get that balance right. How I do it? I simply do this. I get rid of 18 there. I put 18 over here in 18 million here. In current debt, I recalculate. I've still got my 10 million there. I've got my ratio going okay here. It's a bit different. I've got the black one there, which is current debt, and the green one, long-term debt. So they're a little bit, they're a bit different there. So let's go and see what this does to my pro formas. 8 out of 8 for leverage, 5 out of 5 for days of working capital. I fixed it. So the formula that I gave you about borrowing through issuing stock and issuing long-term debt works for will work for 4 rounds, providing you've done everything okay. And basically, what's that? Because your company started and you had an even balance in the first place. If you didn't have an even balance between your equity and your debt, that formula wouldn't work. But I know it does, and that's why I've recommended you do it that way. But as your company goes on, competitors do things, you make a few slip-ups or changes or overinvest or underinvest, things need to change. So in order to be able to balance out leverage, in order to be able to get your days of working capital up, I needed to be able to come over here and borrow current debt. So that was the aim of today, to give you a bit of an idea about how you can improve those two things, because many people will have that dilemma, usually in the last few days before the assignment is due, second assignment is due. I've showed you around the pro formas, I've showed you the limitations of the pro formas, and we'll see what that actually did to my my balanced scorecard down there. 54, it was on 52, I think. So I increased that by a little bit. But remember that this is very inaccurate, and it can be inaccurate. Once you learn how to use it, it's fabulous. But a lot of students get confused by thinking that's what I've got, and that's what my score is going to be. So I hope that helped, guys, and see you soon.